one, Timothy, you posted should be the right one.
864-629-3906.
Okay, all right. I think we're good. Okay, we can get going. I see a lot of people have joined in now. Yeah, there you go. All right, so Tim, I'll let you allow anyone that comes in, that way we can focus on the presentation.
Okay.
All right, so welcome everybody to our next derivatives presentation. I have Geoffrey Radio with us today, and he's a risk manager at NSE, Next Derivatives Sector, the platform. And what I'm showing right now is their website. For some reason, Geoffrey, a lot of people usually don't find this website at all. I don't know. We may have to talk about it, but that's the website that deals with derivatives at NSE. And let me start off by quickly showing what happened in today's US markets. And usually a lot of people, when they go through equities, they see this information posted. You know, at the end of the day, if they're coming from work at 4 p.m., they'll hear that the Dow was up at 123 points, or S&P was down, NASDAQ was down, Russell was up. And they usually just dismiss that information as not concerning them. In other words, okay, that's the market, that's the overall market. I have nothing to do with it. All I care about is my individual stocks. Or there will be information about crude oil. You know, they'll be told that crude oil was up, natural gas was down. Yet we use a lot of these products, and they actually carry a lot of weight in what we do every day, or even currencies or bonds. So this is partly part of the futures market that a lot of people are scared of. And we are here to try and demystify this information and at least give people accurate information on what the futures market is, and how they can go about navigating these markets. So if you are in a place that requires muting, or your environment is noisy, go ahead and mute yourself, just so that we can have a better conversation. I'm going to allow everyone to go ahead and post a question on the chat box. If you find what Geoffrey is saying is a little confusing and you want some clarification, it's okay. Go ahead and post that question on the chat box. He'll also take questions at the end, towards the end of the conversation, and he's available for us. So lastly, the one thing I'm going also to mention here is that I posted on our Discord channel, and I'll quickly go over this story. So this man appeared in the village and announced that he wanted to buy monkeys for $10. So the villagers, realizing that there's a lot of monkeys everywhere, they could make quick money. So they went out in the nearby forest and started catching the monkeys. And, you know, this man ended up buying a lot of them at $10. But then supply for monkeys started to fall. And so at that point, they were not motivated as much. So he said, okay, I'm increasing the price now to $20. Ooh, these are now motivated the villagers to go back into the forest and catch more. It's actually double. You know, that's good money. But then supply continued dwindling. He increased the price to $25. Eventually, he ended up asking everyone to catch monkeys for $50. So you could not find any monkey anywhere at all, because now it's $50, all the monkeys are caught. And then what happens? He says that he has to go to the city for an official business, and he would leave his assistant to transact on his behalf. So with the man gone, the assistant says to the guys, you know what, most of you sold the monkeys to him at a specific price. How about you buy them at $35 each, and when he returns, you can sell them to the owner for $50. No, sounds fair, right? So you buy for 35, you're going to sell it back for 50. That's $15 markup. Very good. But guess what? The villagers never saw the man or the assistant ever again. They had taken all their savings and bought the monkeys. What was left in the village? Lots and lots of monkeys everywhere. So I posted this question. I see this game being played right now. Any guesses? So the question here today is talking about NSE derivatives. Who's the monkey? Who's the buyer? Who's the seller? You have to understand supply and demand, and you should not be played at all. So we should not be played. There is a market at Nairobi Stock Exchange, Nairobi Securities Exchange, and there's a platform there for next derivatives, which has a lot of foreigners. They do this a lot, but we do not. So let's get going to understanding what this market is. Let me welcome Geoffrey. Geoffrey, if you're ready, yeah, I'm going to stop sharing the screen here. And whenever you're ready, you can take it away. Welcome.
Thanks very much, Pete. Hi, everyone. Good evening for everyone on your side of the world. Early morning for me. Let's give early morning productivity a chance. Let me just share my screen quickly. Let me know if you can see the presentation.
Yep, we can see it. You just need to maximize it.
Yeah, just waiting for it to load. There we go. Okay, everyone. My name is Jeff Radier. I work at the Nairobi Securities Exchange. Specifically, I'm part of the derivatives department. Joined the team in about July 2017. Just as part of, I guess, the team trying to put together and roll out the NSE derivatives market. So today I'll just take you through, hopefully give you a better understanding of what the market is, what products are on offer, how they work, some items on just pricing, trading the products, how you can participate, and just hopefully give you a much better understanding of what's going on in the NSE derivatives market. Of course, just at any point, Pete, you can just channel the questions to me, and then we'll also have a longer Q&A session at the end, but please feel free, let this be a discussion. So just to start off, very, very briefly. So as I said, I work at the Nairobi Securities Exchange. The exchange itself was founded in 1954. We definitely count as one of the leading African exchanges, or exchanges on the continent for that matter. So especially looking at the region, then Kenya being an important part of the regional hub, then the NSE also plays a leading role in that respect. In terms of products on offer, just generally, through the NSE, you can trade local stocks, bonds, ETFs, exchange traded funds, REITs, real estate investment trusts, and of course the derivatives markets that we're here to speak about. So you may have, again, just depending on different levels of familiarity, you may have heard the name Next, which is also displayed even, there's a logo at the bottom of this presentation. So Next itself is the name of the NSE derivatives market. So you can think of it as essentially just a segment of the overall exchange, NSE PLC, but the name we've given to that particular market is Next. So the two are interchangeable in that respect. And specifically, I'll take you through the exact contracts that we offer, but we offer index and single stock futures, and I'll just take you through how each of those works. So before we jump into what the products are, I think one of the questions that often comes up is why we have this derivatives market in the first place, why we chose to go down this road as the NSE. And I think it's really a conversation around what the local environment currently looks like and had been turning into over time. So really, it's a matter of increasing volatility in asset prices, both locally and internationally. And that's important, one, because of, as I mentioned, Kenya's regional as well as just international linkages. And as that volatility then starts to increase, volatility then brings with it an element of risk, right? So whenever that enters the conversation, then there's questions around what can I do to manage that risk, manage that volatility? And that's some of what we'll speak about. As I say, there's that integration of our own financial markets with those outside our borders. There is a discussion around what we call OTC markets, over-the-counter markets. So could argue derivatives, and strictly speaking, not brand new, even in Kenya, in that in some form or fashion, derivatives have been available through the commercial banks. So think of importers, exporters locking in forward currency prices with the bank. So that's a derivative contract, but because you're going directly to that counterparty, then we describe that as an over-the-counter market. So what is new then is an exchange-traded offering of derivatives. Because you're now going through an exchange, then there's a lot less counterparty credit risk, right? So you're not facing your counterparty directly. The NSE is in the middle of that transaction to make sure all obligations are satisfied, are followed actually. These products then also allow you to manage risk, and that's something we'll just speak about, but manage your risk in a more sophisticated manner. So as I mentioned, as that volatility is increasing, then there's a conversation around the riskiness around your portfolios, whether you're an institution or an individual, there's some element of needing to manage that risk. So as we'll see, these tools then allow you to take advantage of that. And lastly, and probably one of the more important ones, I think just with any growing and developing markets, then as you introduce more types of products, then it unlocks a lot more that you can do, even from an investor point of view. So for a long time, the story in local markets, certainly before derivatives, has been one directional, in the sense that most investors were used to let's focus on shares. So pick the right stock, wait for it to appreciate, right? So there's only one direction in which you would make your money. As we'll see, this product then now makes that a two-way street, essentially, because by using futures contracts, you can actually profit from price declines. So just the concept of shorting is something that now this market has allowed local investors to take advantage of. So in that sense, we're now making ours a two-directional market in that sense. Okay, so in terms of Next itself, we officially launched in July 2019. It was actually the 4th of July, which was just a happy coincidence, no significance there. But we launched in July 2019, and as I said, we offer futures contracts. So in the, again, we can have just some Q&A, ask me questions at any time. In the scope of just basic derivatives that are available, you then have futures contracts, forward contracts, options, and swaps. And each of those then come with, excuse me, slightly different attributes depending on the type of contract. But futures and forwards are often your simplest types of derivatives. And because we're talking about an exchange-traded ecosystem, then we're looking at futures contracts. Specifically, the elements coming into what we are now calling a futures contract. I think this might be familiar to some of you who may have trading experience, especially just trading on different markets online. That futures contract is essentially an agreement to exchange an underlying asset at a future date, right? And you're fixing the price of that asset today. So we're agreeing the quantity quality of that asset. We agree a price today, but the exchange is meant to happen later on. Let me try and, without implicating myself on the wrong side of the coin, let me try and use Pete's story just now about the monkeys in the village. So had that guy shown up again, there was almost an implicit agreement there, right? That I will come back and I will buy one monkey from you, say 6 months from now when I'm back, at whatever the price was, say $50, right? Implicitly in that arrangement, you could be said to be already structuring a futures contract or a forward contract, strictly speaking, since that would not have been on an exchange. So we know what that underlying asset is, we know what the price is, we know when that exchange will happen. We also have then something to consider called specifications, which I will walk you through for our products. These specifications just tell you the parameters of the agreement, essentially. So again, to use the same example, if each contract is for one monkey, right? Let's even say one brown one. No one missed Pete's story and is wondering why I'm referring to wildlife. So in that agreement, we've then specified quantity being one, say a color being brown, right? That's a specification. And you can apply that then in various forms. If it's something like a commodity, then you're saying maybe one bag of maize, grade A, right? So those specifications then speak to what are the exact parameters. Of course, because this trades on an exchange, then it's a futures contract. And there's also the concept of daily valuation and settlement. So unlike shares, and we'll touch on this a bit later, but unlike shares, then these contracts need to be valued on a daily basis, valued and subsequently settled. So your P&L is actually realized on a daily basis. So just some of the differences between this market and trading shares directly. In terms of how our market is currently structured, we then have a tiered structure with a hierarchy as displayed. So at the top we have what's called a clearinghouse. In our case, this is an entity called NSE Clear. So its function is just to undertake clearing and settlement of these contracts for the market. So clearing is just computing the obligations of the investors. So trades have happened today. We need to, at the end of the day, almost have be able to have a statement saying Pete has traded so many contracts, Tim has traded so many contracts. These are their obligations, right? As far as margin payments, profits and losses, transaction fees, that process of just computing that is the clearing process. Settlement is then the fulfillment of those obligations, right? So think of it as your statement telling you need to pay in $50. So the settlement is your actual movement of cash to satisfy that obligation. Because we are not ourselves a bank, we then have what are called clearing members or clearing banks sometimes. And they then assist us with that same duty in undertaking part of the clearing function for the brokers below them, but most importantly, undertaking the settlement function. So they assist us with moving funds throughout the ecosystem through that settlement duty. Below the clearing members, we have what we call trading members. So your trading members are just, in our context, brokers and investment banks. So at the moment, what is it, maybe 23, 24 brokers available through the NSE. We then have about, is it 9 now, who participate in the derivatives market. So brokers that participate in the derivatives market, we refer to those specifically as trading members. But for all intents and purposes, these are just your normal brokers and investment banks who then have that duty of executing these derivatives trades or these futures trades specifically, either on their own accounts or on behalf of yourselves as the clients, as you see at the bottom tier there. And these clients really can be anyone, can be you and I as individuals or retail investors, can be institutions as well, and importantly are both local and foreign clients or investors who will come to market for a number of reasons. So some will be looking to, I hinted at using these tools or these products for risk management. So you could be coming to this market because you have a portfolio of shares that you're worried about, and you're looking to manage some of your risks that you're exposed to using these products. You could be coming to speculate, right? So you've seen a more capital efficient way to trade. I'll talk about margin requirements and just how that makes it a capital efficient way to trade. Or you could be perhaps looking for some arbitrage opportunities, because as I said, we now have not only a two-directional market in the sense that you can go long and go short, but you now also have a futures market as well as an underlying equities or stock market. Right? So sometimes there'll be opportunities across the two. So clients will come in for a variety of reasons. In terms of the specific products and fees that we have on offer, as I mentioned, we have started with futures contracts for now, specifically equity futures. And the two then categories of products we have available is one, an index contract based on the NSE 25 share index, and two, futures contracts on a number of stocks, which I will show you a list of. So in terms of the index contract that we have available to trade, as I said at the moment, it's the NSE 25 share index as the underlying asset, which is one of our indices available on the exchange. So we have an all share, we have an NSE 20 and an NSE 25 in terms of what is in-house to NSE. So without this derivatives market or this contract, just so everyone can appreciate it, that the index is essentially just a benchmarking tool. Right? So it's an aggregation of the performance of its constituents. At the beginning, Pete mentioned the Dow Jones, for example. So the Dow is up today, the Dow is down. Strictly speaking, that's just a benchmarking or aggregation of the performance of those constituent counters. And without products such as these, then what you find is that often they are used by fund managers, most often, who need to be able to compare their performance versus some sort of widely accepted benchmark or proxy for market performance. So in our case, we have the NSE 25 share index, essentially our top 25 counters. So what this index contract now does is make that a tradable asset or security. And through, these are the specifications that we have. So specification 2, contract size. So in our case, for this particular contract, one index point equals 100 Kenyan shillings. So I've just done a quick conversion there for you, roughly $1. It's actually a bit less right now, but for a long time, just a quick conversion is just 1 to 100 in terms of the exchange rate. The minimum price movement then is one index point. So essentially each time this index ticks up or down, then you're making or losing 100 shillings, which is $1. The other specification to this contract is the expiry months. So pretty standard in terms of what many derivatives exchanges do. We have quarterly contracts. So contracts that expire in March, June, September, and December of every year. You'll always have up to 4 expiries available to trade. In terms of how these are settled, so going back to our definition, a futures contract is an agreement to exchange that underlying asset. So because I cannot, try as I might, bring you one physical index, we then settle this contract in cash terms. So we're just exchanging that cash difference. So you'll often hear associated with derivatives that you can settle either in cash or settle physically, i.e. delivering the physical asset. So for the index contract, we settle in cash, Kenyan shillings. The last two Let me skip to the last one for a moment. Expiry dates. So earlier I mentioned contract months, March, June, September, December. The exact date that these contracts then expire is the third Thursday of each expiry month. For example, as we speak, the June contract is due to expire on the 17th of June. I believe that's the third Thursday. So going back to settlement price, as I mentioned, these contracts are valued and then settled against that valuation on a daily basis. The way this is determined is if contracts have traded on a particular day, we take the VWAP, volume weighted average price, which is the same methodology we use for the underlying equities market. And that's simply to say, this has been today's trading activity on this contract. What was the average price for today's activity? If contracts do not trade, then what would happen is we would carry out a theoretical valuation of that contract just in order to be able to produce this final, not final, but the day's settlement price. Because remember, we need to be able to value these on a daily basis so that we know how profits and losses are computing for all counterparties. Because again, as we'll touch on a bit later, these products need to be settled on a daily basis. So unlike shares that you can buy and hold for years, for decades, even pass them on, these contracts, one, actually expire. Shares don't expire, right? So we need that mechanism to be able to settle and price them on a daily basis. Yeah, so for the index contracts, just your key takeaways, in our case, is the NSE 25 share index. One index point equals 100 Kenyan shillings, or roughly $1. The second category of futures contracts we have are single stock futures. So as the name implies, in this case, the underlying asset is or are underlying, qualifying stocks. So the underlying asset are shares that trade on the NSE at the moment. And we have a selection criteria for these counters, which essentially are that the counter should be a member of the, one, listed on the NSE, obviously, and two, a member of the NSE 25 share index, and then have a market capitalization of at least 50 billion shillings, trade on average over the preceding 6 months, at least 7 million shillings. So that's what just assists us with then selecting the counters that are eligible to trade as futures contracts. So not all of our NSE listed stocks or equities trade as futures contracts. We use that selection criteria to select what will trade on this market. And I'll show you a list of those companies next. In terms of the contract sizing, so previously for the index, we had said one index point equals 100 shillings. In the case of the single stock futures, what we do is assign a quantity value to each contract. So for shares that trade below 100 shillings, one contract equals 1,000 underlying shares. For those that trade above 100 shillings, then one contract equals 100 underlying shares. So each time you trade one of these contracts, your equivalent position is the contract price times the number of underlying shares it represents. The price movements here, this just speaks to the tick sizes or price changes you would see. So for the index, we said minimum price movement was 1 index point. So for example, if the index was trading at 4,000 points today, the only other possible prices you would see on that contract would be 4,001 or 3,999, right? So those are the increments. In the case of single stocks, then depending on the price range that the contract trades in, we then have these increments, so 1 cent, 5 cents, 25 cents, depending on the price. The other specifications are pretty standard in terms of even comparing it with the index contract. So these also have quarterly expiry dates, third Thursday of those months, so March, June, September, December. At the moment, these are also settled in cash. So while it is possible for me to deliver the underlying asset to you physically, so to speak, as a share, we have currently started with just a much simpler mechanism of settling in cash. So we're just exchanging, you and I just exchanging that P&L difference. Right, and settlement price works the same way. Volume weighted average price for the day's trading. If a contract did not trade, then we do a theoretical calculation. But all of that is just handled by us. Don't need to worry too much about that, but just suffice to say that there will always be a settlement price for these contracts each day. Pete, I think there's some, I haven't checked yet, but are there some questions on the chat, or should I just carry on?
Yeah, there's a few questions I think you're going to cover this most likely. The question was, what brokerage firm supports the derivatives market? You might be able to cover that one.
Yeah.
And then the other question before you go from the description is rollover. Can you roll over the contracts upon expiry?
Yeah. Okay, perfect. The brokerage one, I will show you a list of qualified institutions that you can trade with. So the brokers and investment banks or trading members, I'll show you a list of those. In terms of rollover, yes, you can roll over your position. In our case, I think in comparison to a lot of online platforms you might be familiar with, the rollover itself actually needs to be initiated by the client. So you can then elect when it's coming close to expiry to close your position and reopen your position in a further dated contract. So for example, the Junes are expiring, you can switch over to the Septembers yourself. So in that sense, you are allowed to roll over. There's no restrictions on that. Having said that, you're also not required to hold these contracts until they expire. You can open and close the same day, the same morning. So you can certainly roll over. In terms of the contracts we have available, so hopefully at least one of these is familiar to everyone. Safaricom, KCB, Equity, ABSA, EABL, and BAT. So Safaricom, the telecommunications industry, a few banks in KCB, Equity, ABSA, and EABL and BAT, more on the manufacturing side. So what does it cost to trade this market? In our case, these are our fees. So all in, you're looking at paying 17 basis points, 0.17% for single stock futures. And for index futures, you're looking at paying 14 basis points, 0.14%. And the breakdown of that is just as shown. In the case of single stock futures, NSE 2.5 basis points, same as the clearing member. Trading member 10 basis points, and then the statutory levies in terms of, we have an investor protection fund that's there really to compensate investors in case of any malpractices, particularly by trading members. Then that collects 1 basis point of all transactions, and then a levy of the same to the Capital Markets Authority. So this is one of the key value propositions of this product, especially comparing the local alternatives, which really is, you can either trade, pick something here, you can either trade EABL as a share, or you can trade it as a futures contract, right? Should you elect to trade it as a futures contract, then your fees are much lower than trading it as a share. So for example, essentially your cost of trading shares directly, in our case, ranges between 1 to 2%, depending on the size of the trade, or even just relationship with the broker. But most often, especially in the retail context, you're paying actually 2.1%. So this market is really that much cheaper, almost by a factor of 10 times or more, depending. So then futures trade worth £1 million would only attract a fee of 1,700 shillings, or $10,000, $17 thereabouts. So much, much cheaper to trade this market. I'll just quickly walk you through our margin structure, just to give you an idea of sort of the capital requirements of trading this product on this market. So just quickly, as I've been hinting at, the differences between trading the spot market, i.e. actual shares, versus these future contracts, you require your full cash upfront, right? But trading this market then affords you the benefit of having some leverage through margin payments. So that margin is just a good faith deposit upfront. Your P&L, as I said, with shares, you can hold that share for many, many years if you wish, and you only really realize your P&L when you exit it. For futures contracts, we then settle on a daily basis. So your trading account then is either credited or debited on a daily basis through that clearing and settlement process I spoke about earlier. In terms of settlement cycles, just for your information, our cash market settles on a T+3 cycle, while derivatives settle T+1. So the types of margins, I just thought it would be good to include this here so you have sort of a full picture once you do decide to sort of interact with the market or our brokers. So the types of margins that we have then in our market: initial margin should be a somewhat familiar term. So initial margin, additional margin, house margin, variation margin. Quickly, what each of these are. Initial margin is what the exchange charges for each contract. I'll show you the cash amounts for each of the contracts available in a moment. But this is your good faith deposit to NSE. It's collected from both the buyer and the seller. We hold that for the duration of your contract. So whether you're waiting until expiry or you decide to close out your position even on the same day, your margin is just a deposit and it's refunded to you once you exit the market. Earlier in our structure, I spoke about the clearing members. So below NSE, we have banks that assist us with the clearing and settlement process. Because those banks are then in the system as well, in that sense, and taking on some risk, then the banks have it's provided for that the banks can collect what's called an additional margin. So the way this is handled is it is a percentage of what the NSE is charging on each contract. So the NSE might say it requires 1,000 shillings for a particular contract. The bank that your trade is going through could then add a 10% requirement on that, right? So a further 100 shillings. So it's just a small top up on what the NSE is collecting. House margin, particularly important for mostly retail and individual traders who would be depositing cash with trading members directly. Whenever you deposit cash with the trading member, they are entitled to just put aside a small portion of those funds and let you trade with the balance. The reason for that is essentially these margins allow at each step of the hierarchy for a participant to have some sort of cash put aside, such that should there be any issues with maybe a client funding their account, there at least is a small reserve of cash available, right? And this works the same way. In the case of house margin, then at the point of onboarding with the trading member, then one of the elements that would be captured in your agreement is what proportion of funds you are happy to have held aside by the broker and then trade with the balance. So for example, the broker might say 10% of any funds you give me, I'll put aside, allow you to trade with 90%. So it's really just a risk management mechanism in that sense. But in essence, these three margins, initial, additional, house, are just your upfront margin or cash deployment to allow you to access these contracts. Variation margin is just a fancy way of saying profits and losses. Right? So by how much has the value of your position varied on a one-day basis? One-day basis because, as I said, we settle on a T+1 cycle. So your variation margin is actually the P&L that you're seeing on your statement on a daily basis. Of course, the way we arrive at that is a process called marking to market. So I spoke about settlement earlier and how there'll always be a settlement price. What we're doing is marking the value of your portfolio to where the market currently is. And that then allows us to compute this variation margin. But all of this is handled by systems in the back end. Don't need to worry too much about it, but just to give you an understanding of what is going on. So just to give you some figures, the other question that often comes up is, okay, so how much do I need to participate in this market? So in our case, that's really a function of which contract you're trading and the quantity of that contract you're trading. So what you have here are margin requirements for each of the available contracts at the moment. So if you want to trade Safaricom futures, this is, I believe these are margin requirements for our June contracts at the moment. So if you want to trade one June Safaricom contract, your account must have at least 3,800 shillings, or roughly $38, right? Just to give you a quick conversion there. So depending then on how many contracts you're trading, then your margin requirements rise in line with that. Talk about leverage. So because if you can see the final column there that says contract size. So Safaricom, for example, has a 1 to 1,000 contract size. So in effect, each time you trade a Safaricom contract, whether you're buying or selling, the value of that position, or the notional value, is your traded price times 1,000 underlying. So currently, Safaricom has retreated a bit, but let's just use a price of 40 shillings. So each Safaricom contract then is exposing you to 40 times 1,000, 40,000 shillings, right? In terms of your exposure, or $400. But for that equivalent exposure, you only require to put down this $38 margin requirements. So you can see significantly more capital efficient in that respect. So all the way down to the index, which you can trade, the index being a larger contract. So I think index currently is trading at around 3,500 points. So in Kenya shillings, that's an exposure of about 350,000 per contract, but you're only required to pay 42,000 for each contract. One thing we are looking at is introducing a mini index. So some of you might be familiar with mini indices available to trade on that side. So we're also looking to introduce something like that, just to make the index more accessible to retail traders especially, right? Just as I near the end, just show you some examples really and how markets have gone here. So 2020, the story of 2020 is not lost on anyone. And that came with a lot of negative performance on various securities, locally, internationally. So in our case was no different in terms of the majority of these companies then seeing downward movement in terms of their valuations. Then, of course, we had investors that took advantage of this by trading futures contracts on these contracts, on these companies rather. Because then your futures trades are leveraged, you're then able to enhance your returns in that respect. Safaricom was the only one to sort of buck that trend, the recovery around Q3 of last year, so allowing it to close just net up. These are net returns, so just factoring in some assumed fees, just to sort of give you an all-in picture. So comparing that to then 2021, where I think even globally we've started to see a few recoveries here and there. But again, the story remains in terms of futures contracts allowing you to leverage your position. So in the case of just ABSA there, which had negative performance, then you would have shorted that one. But for each of these other counters, then there was opportunity between January and March to just take a long position in those contracts. Quickly, an example using KCB. The exposure I've put here is 25 million shillings, which is about $250,000, but market is open to everyone, right? So as I said, whether you're an individual investor, an institution, you can trade one contract, you can trade hundreds of contracts. There's no restriction really. But I think what I just wanted to bring out here, and it's often part of the value proposition and just demonstrating the difference between trading shares and trading futures. You can see that for an equivalent exposure in KCB in this instance, you would have required, just working in Kenyan shillings, you would have required 25 million upfront to get 25 million worth of exposure, right? But in the futures market, then you're only looking at deploying your margin requirements, which at the time would have then come to a fraction of that, about 3.4, 3.5 million shillings. Then depending on your entry exit prices, in this case, there was actually an upward swing in terms of the valuations. So from around 38 shillings start of year to about 40 shillings in March. At the moment, I think it's even gone up to 41. You can then see there was an opportunity to make a return on the buy side. So I'm taking a long position in these contracts. In terms of the trading fees, as I was saying, this market is significantly cheaper. So depending on your final fee, you can see there, it's much cheaper to trade futures contracts, almost by a factor of 10 times. And then the return you then make compared to what you had put in gives you that leverage, which is why you see somewhat inflated net return figures, but that's really because your margin requirements are so low upfront. Of course, then, like any product, and as I close, I'll just cover some of the risks that exist. With any investment you make, really, market could move against you. So shorting this contract would not have been really the trade to take. Hindsight is 2020, appreciated. But you can then see on the sell futures transaction, the third column, you can then see some negative returns there. As I said, importantly, you are not required to hold these contracts until they expire. So like any free market, you can enter and exit as you please, just dependent on liquidity conditions. Yeah, so lastly, just so what we're really saying in terms of benefits, value proposition, you can take advantage of these products to hedge your portfolios. So if I go back quickly, you can see that maybe I already had, in this case, KCB actually appreciated, but let's say the market actually went down. So you can go back here. So that negative performance on the equities book, I could have offset it with positive performance on my futures book or portfolio. So in that way, just hedge my exposure. And that's really a powerful proposition, even for institutional investors who then have portfolios to protect. We now have a wider variety of trading strategies. Shorting is probably the biggest take home. You can now actually short securities. You can trade the index. If you don't want to bother with picking individual stocks, just trade the index. It gives you exposure to what the overall market is doing. Leverage is now available in terms of margin requirements, which previously for shares, you would have needed your full cash amount upfront. Transaction fees, I think I've harped on about this for a bit, but it's much lower to trade, much lower fees in this market. Because NSE Clear then is novating these trades, then there's a lot less counterparty credit risk compared to trading derivatives over the counter or facing the counterparty directly. Leverage, of course, will go both ways. So while you're only required to put in a small margin up front, depending on how the market moves, then you might find you're receiving margin calls. So you could potentially lose more than you had put in as your margin. So those of you with trading experience, that will definitely be something familiar to you. In terms of default proceedings, as I mentioned, we collect those margins at various levels to just assist us fulfill settlement should there be any issues with clients. So the golden rule is settlement will always happen. You never need to worry about who you've traded against. Should there have been an instance of default, your brokers then are entitled to sort of close positions, recover costs, and just something to be aware of. We also don't want errant clients who maybe open multiple accounts and default here and there. So just something to be aware of. Market risk will follow you with any type of investment you make. So just has the market moved in your favor or not? Liquidity is something we've spent a lot of time working on since we launched in 2019. So how easy is it to enter and exit your positions? What are liquidity conditions like? One of the key elements of progress, so one of the key areas we've really succeeded with this, was introducing a market maker or liquidity provider in December last year. And we've seen the liquidity pick up significantly in that respect. So liquidity is both a function of just having more contracts trading, but as well as more investors joining the market. So certainly it feeds in on itself, but we now have a market maker available. Operationally, we spend quite a lot of time with the participants, making sure they're ready and understand what they need to do. So even the brokers you would be interacting with then should be fully equipped. We did quite an extensive pilot testing period before we launched in 2019. So just making sure the sell side really is ready for you as you come to market. Pete, I don't know if we have time still. I just tried to squeeze in a few trading highlights just to give everyone an appreciation of.
No, we still have time, Geoffrey. If you can just complete, I think a lot of people are observing. There's a lot of information people are trying to jot down, so keep going.
Yes, 100%. Okay. Yep. So just to give you an idea of what things are actually looking like, especially the trend and trajectory since we launched. So in 2019, let me just speak in Kenyan shillings here. We had an overall turnover. So 2019 was effectively a half year because we launched in July. So we had a turnover of just over 20 million shillings, volume of just 500 or so contracts traded. The following year, we essentially doubled that, came to 40 million shillings in turnover and a volume of 1,255 contracts traded. And then, as I mentioned, in late 2020, we then introduced a liquidity provider. And as you can see, essentially in I think this actually goes to end of April. So 4 months of trading, we've then done about 76 million shillings. So compared to similar period, we're over 400% up in terms of activity. The average daily volumes also increased significantly. Before market making, we were typically looking at average daily spend of turnover actually of about 200,000 shillings. But that's risen to close to 1 million shillings at the moment. And that's really been a benefit or advantage of having the liquidity provider present. So the trajectory has been quite positive, especially this year, just in terms of picking up. And as I said, it's both a function of existing players trading larger and larger positions, and as well as having more and more traders such as yourselves actually participating on this market. So representation of the same, you can see really 2021 has been a good year just in terms of that trajectory. We still want to continue to scale this up significantly just to hit sort of the numbers we're looking at. But in terms of trajectory, pretty happy with that. And then for Q2, we're definitely on track, I think, to at least match Q1, if not surpass it. In terms of what the securities look like, as far as trading activity or preference, this is in terms of turnover. This, for those of you familiar with like local market conditions and trading patterns, this is pretty similar to how shares trade, in that Safaricom is a pretty popular counter to trade. Safaricom and the banks actually. And then because the index is now tradable, we're seeing more and more investors actually trading the index contract as well. Because of the size of the index contract, then you'll see it actually takes up quite a chunk of the activity. But certainly a lot of activity is centered around the single stock futures. And yeah, so similar story in terms of improvements with open interest. So you'll see quite a bit of a ramp up, especially in 2021. The fall-offs you see are really just coinciding with expiry periods. So at the moment, we still have a number of investors who prefer to let their contracts expire rather than roll over, to the earlier question. Although it is indeed possible to roll over your contract earlier if you wish. And I think we're seeing the speed of just open interest building up, being a lot more accelerated since we introduced market making. Finally, the trading members you can engage. So we have a list on our website as well. So there's more information as well on the website. If you need to look through any of this again, I believe the presentation will be shared as well. However, just to give you an idea of who is available, these are the trading members we have available, currently trading. So AIB Access Africa, Sterling Capital, Friday Investment Bank, Standard Investment Bank, Kingdom Securities Limited, Genghis Capital, CBA Investment Bank, and EGM Securities has recently also began trading our market. So you can approach any of these. In terms of your KYC requirements, pretty standard. And I don't believe there's any challenge with sort of diaspora accounts because it's really just a matter of your KYC. So typically identification, utility bills, that sort of thing. Sign a derivatives agreement with the broker. One thing for those of you who might be familiar with trading shares in the local market, you do not require what's called a CDS account for this market. So usually when you're trading shares, you'll open an account at the broker, and you also have what's called a CDS account with the depository. But for the derivatives market, it's as simple as just one derivatives trading account that you open with your preferred broker. So it's that much easier and quicker to open an account and begin trading. Then once you do have that account, you can either have your broker trade on your behalf or upon instruction, or request access to the trading system as to execute trades on your own. Yeah, that brings me to a close of my content. Maybe can jump into, I'm sure there's quite a few questions or anything that needs to be clarified.
Yes, there's a bunch of questions here. Thank you so much for that simple explanation. A lot of people think futures is complicated, but I think you make it very simple. It's just, the jargon might confuse some people, but once you understand what it is, it's fairly simple. All right, so you have a question here from Esther about ATR, average true range for the NSE. I think it's the share index. On average, how much does it move up and down?
Well, for the index specifically, I'm not sure I included it here, but what we do have, let me start with the extremes and work backwards. We have price limits that we set on all our products, including the shares, the equities market and the derivatives market both have a 10% up-down limit. So no one of these counters would move more than 10% in a day, except on days that, let's say, there's been a corporate action and then there'd be an announcement just announcing that limits have been lifted. However, I think on a day-to-day, we probably don't see a deviation of more than 2-3%, depending. And that's probably also important from a trading point of view. I didn't include it in this presentation in terms of the sort of how soon you can break even. So in the equities market, you then need to make at least 4% to break even, right? And that can take a few days, even up to a week, assuming the market is moving in your favor. For the futures contracts, then your break-even points are significantly lower. But I'd say, just top of my head, give it something like no more than 2-3%. But it's certainly something I can chat with you some more, Pete, and maybe that's information you can relay.
Okay. All right. All right, and then I have some people looking way forward. There's a question about options. Are you planning to, is this just futures or do you have options?
Yeah, so at the moment, just futures contracts. I think options we would look at down a bit further down the road, just because of needing to get the local market perfectly comfortable with the existing product. So derivatives being a new type of product, a new segment, just needing to get everyone comfortable and get even the liquidity levels higher. So it is something we would look at, but I think that's still a ways down the road.
Mm-hmm.
What's more likely or perhaps closer is futures contracts on additional asset types. So the moment we're speaking about equity futures, right, on shares and equity indices, so fixed income or bond futures, currencies, commodities, that's probably the more immediate steps to take.
Oh, so there might be futures contracts on agricultural products like corn and potatoes and.
That, yes, that is the plan. Although you will appreciate that any derivatives market first needs the underlying market to be sorted out really and to have those structures, which is why it was very easy to introduce these equities futures because the stock market already exists. So yes, there are plans in place for commodities exchange and eventually commodity derivatives. There's still a bit of work to be done on the underlying market, but it's certainly something in the pipeline.
All right. How about the most crazy asset right now, cryptocurrencies?
Pipeline, but much further down, I'd say. I think the funny thing with cryptos is, regardless of which market you're speaking about, whether it's the US, whether it's Kenya, whether it's China, whether it's wherever, there's still a bit of apprehensiveness, let's say, with just maybe how volatile those markets tend to be before you can then see them trading on exchanges and things like that. Dependent on, I guess, market demands. Ultimately, it's this conversation will always be driven by the demands of the market, including what other shares will make available to trade as futures, what other assets, including cryptos. Then that will always be a market-driven conversation. But I would say at the moment, maybe let's not hold our breath on global cryptos.
Okay, all right. All right, there's one more question about, this is from Rose, percentage calculated when rolling over. I didn't quite get the question, Rose, if you can repost it. What's the percentage calculated while rolling over? I don't know whether in terms of contracts, I'm not sure about that question.
Yeah, maybe just while she rephrases, if that's in reference to, I know some online brokers especially usually charge you rollover fees or something like that. And I think that's a function of what you're trading with online brokers are actually CFDs, contracts for difference. And so there's some associated costs that the broker has to onboard, which is why they then charge you those percentage fees as well. In our case, it's as simple as, I can go back to it. It's as simple as these trading fees. So in the act of rolling over, you're then closing your June contracts, for example, opening your September contracts. So it's really take double that, so 34 basis points, let's say, for your single stock futures.
Correct.
So in our case, we're just looking at it in terms of a normal transaction. Close this leg, open that leg. Nothing extra on top of that.
Correct. Okay. This is an interesting one. So those that missed my analogy at the beginning of the presentation, I gave a story about monkeys. So this is a good one, Geoffrey. It's the question is, based on that analogy for monkey business, what are the signs that the businessman, you know, this guy that was buying monkeys, what are the signs that he's about to exit the market?
I think maybe that speaks to
foreigners, whoever is holding huge contracts.
Yeah, that's really now in the driving seat, on the engine room of your trading strategies, your indicators, what you'd be looking for as you trade. I think I think what you'd be looking at, maybe you already do this with markets you trade at the moment, you'd be looking at things like how open interest is changing. So you can tell maybe the June contracts have this much open interest. This is how, and then maybe there's a significant movement of volume spike, open interest has changes, and maybe we're not yet very close to expiry. Maybe someone is making a move. So there's all those sorts of indicators you would look at. I think that really just comes down to the types of indicators you want to look at and the type of trader you want to be. In our case, I think because this is still a very new market and in some respects a very thinly traded market, maybe we tend to trade more on fundamentals than technical analysis at the moment, which is why, as I was saying, if I can quickly go to trading highlights, you'll often see that this distribution, aside from the index, which is not tradable on the underlying market, often closely mirrors what the underlying market is doing. So it's more about the fundamentals. Our results looking good on the banks, on Safaricom. Our market is also pretty heavily influenced by foreign investors, especially foreign institutions. So you'll find sometimes that a lot of the movements then are coming from foreign buyers and sellers coming in. But if I had to go either way, I would say our market tends to be pretty heavily based on fundamentals. So the sign of the man who promised to come back and buy the monkeys not showing up, that's probably more on sentiment and news around the companies, rather than, I think, in very liquid and fast-moving offshore markets where you'd be tracking more indicators like volume, open interest, things like that.
Correct. You may also actually talk about percentage of foreign investors. What's the percentage there? Who does a lot of work here? Is it individuals or foreigners?
It's so our market is anywhere between 60, sometimes even 70%, influenced by or dominated by foreigners, foreign trading activity. Specifically, that most often comes from foreign institutions. And then the balance then is your local players, and the bulk of that then tends to be local institutions. So the retail space is really a bit thin at the moment, but something we're looking to grow, both in the futures markets and the equities markets. So in terms of a high level breakdown, that's the type of influence we have. And that's for the equities market specifically. For the derivatives market, again, just it being a new market, new products, you'll often find that it's the retail and high net worth clients who give you a lot of that early support. So for our futures contracts specifically, our futures market, this activity has really almost exclusively come from individual retail traders, local retail traders, and one or two more flexible institutions or balanced funds.
Mm. Yeah, that's very good to hear.
Market, yeah.
Yeah.
Derivatives market is pretty retail dominated.
Yeah, it's glad to hear that a lot of these activities individuals. So you can imagine that, actually people in diaspora haven't even tapped into this market. So the more we can expose a lot of people to understanding what this is, will benefit quite a lot.
Correct.
All right, so there's a question from Raf. Comparing our Kenyan derivatives market to those around, how solid are we in comparison? Is there a derivatives market in Uganda?
No, so we are actually the second derivatives market on the continent, sub-Saharan Africa, if you want to be very specific. So the leading market really would be the JSE, the Johannesburg Stock Exchange in South Africa. So, and they've been trading derivatives since the 80s, I believe. So they've got quite a leg up on us. But in terms of how solid the market is, we have modeled ours very closely to how the South African market works. as well as some influences from the Indian market as well. So in terms of best practices, structures, I think we're pretty solid in that respect. It's now more a matter of just getting more and more investors participating, getting those volumes up. The other region that's now venturing into this space from an exchange traded derivatives point of view is Nigeria. So hopefully we stay ahead of them, continue to stay ahead of them. But yeah, so I think on the continent, you're looking at those three sort of hubs, but we are more or less officially the second exchange traded derivatives market.
Very cool. All right. Thanks, Peter, for this question. Where if you wanted to trade, would it be based on real-time data, or this depends on the broker you're using?
In our case, it's real-time. I think, again, that question speaks to trading. When you're trading offshore markets with a lot of online brokers, then yeah, there's questions around. I believe they also try for real-time feeds as close as possible, but there's maybe questions on spreads, commissions, things like that. But with this market, because you are really trading directly on the exchange and with our direct members, then everything is real time, and even your pricing is exactly what is available on the market. There's no really spread markups that the broker is showing you compared to what they're seeing on the market. So in our case, you're really almost plugging in directly to NSE.
All right, very cool. How can we help to grow this market? As those over here in diaspora, is there, and I know this is a good start where we at least can have you explain what this market is, but is there any other way we can help grow that market?
Yeah, I think participation is usually the most direct way. As I mentioned, there's no restrictions really with the local brokers as far as opening accounts. So it's a combination of just that awareness. There's still too many people for my liking who maybe are like, oh, we have derivatives now, even locally. So awareness definitely goes a long way. So sessions such as these, Pete, I think we've spoken about just getting you some regular information, reports, and things like that. Maybe those are things even your community can sort of share with people. So it's a combination of, I think, that awareness and just jump in and participate. I think as with most new products, new markets, there's far too many people who are waiting to see what the guy next door does, right? And we end up all waiting for each other.
Correct. All right. All right. Thank you very much. Though I was curious about your presentation was really detailed. There was something that you mentioned, which is important for anyone wanting to do this, operation risks, where you mentioned that you have to be familiar with market conditions and market, whatever market you're going to trade, you need to be aware of what you're getting yourself into. Because in one of those slides, you mentioned that you can be closed out or penalized. I don't know what that means. Penalized means what?
Okay. Let's go back to it. So I think when we were talking about, so let's speak about default first. So our market is pre-funded, number one. So there must be funds available in your trading account in order for literally the system to accept your orders. However, once you have traded, then depending on how market conditions are, so if the market is moving against your position consistently, then it's eroding that free capital you have in your trading account. Your broker would then be reaching out to you to top up funds, so a margin call. Should you be unable to do that, then there's a possibility that your account essentially is approaching or at risk of going into the negative. So what your broker then is at liberty to do. One, I mentioned at the point of onboarding or whenever you deposit funds with them, they can hold a certain portion of those funds aside So the first remedy, if you want to call it that they can use, is utilize some of those funds put aside to fulfill settlement. So let's say you needed to settle 10,000 shillings by tomorrow morning, right? The broker is sitting on a pool of 50,000. They can take something from that and use it to settle, and you continue to hold your position. Maybe those funds are depleted. The broker could also decide to sort of cover you in terms of that day's settlement, depending on your relationship with the broker, of course. Failing that, they then have a decision to make on whether they will now go into your account and close out your position or reduce your exposure, just to sort of free up a bit more capital. So those are the types of remedies your broker would be thinking through. Of course, if this issue is escalating further than that, the broker has an issue with the clearing bank. The clearing bank then also has those same conversations. In the worst case scenario, there's an issue at the bank level, then NSE is having those types of discussions. So in terms of the penalization, really, I think what I was referring to is one, just that risk of your positions being sort of forcefully closed out if your broker is unable to get top-up funds from you. Two is we also just want to be wary or cognizant of a possible scenario where a client has opened an account here, has done some trades, maybe has not been funding that account, has defaulted and disappeared, shows up at another firm, opens an account, does the same thing, another firm. So we also need, from a governance and almost regulatory point of view, be able to sort of keep track and discourage that type of behavior. So it's more in that respect rather than an automatic fee penalty or anything like that. So just be aware.
Okay, very cool. All right, CPG, thanks for this question. So, and I can mention this. You listed some companies. There are companies that you obviously posted that are listed here, and
Yes.
I have to point out, when you're trading stocks, you would just go and find ticker symbol KCB, for instance. But if you're trading derivatives, it's a 4-letter digit. Now I see a G, KCBG. So the question here is, there are plans to add other companies, non-Kenyan companies.
Yes, that's something we've discussed actually. It's something we would be happy to do. So we're just looking at the requirements, the various modalities, even operationally, to get that going. It is something we have discussed and could possibly be done in the not too distant future. But as I said, this will always be demand driven. So one, we can expand our offering even of local companies. I mentioned that these essentially need to satisfy certain criteria, and then we pick from a certain pool. So we could expand that pool, one, even with local counters, but there definitely has been some thought given to offshore companies as well. So don't hold me to a timeline yet, but it is something that's very much possible to do.
All right. Can you also speak to tax percentage deductions, capital gains? How does that work?
Okay, so in the Kenyan market for exchange traded products, you don't have an exposure to capital gains tax. That's something that we've managed to successfully lobby for over and over. And now with the derivatives market specifically, there are no capital gains taxes. And of course, because these aren't the actual shares that you're holding, there's also no dividends accruing, so no dividend withholding tax. But yeah, strictly speaking, from a capital gains point of view, there's no CGT, capital gains tax.
Oh, that's awesome. Wow.
Yeah. So your profit on your swing is purely yours. I'm not sure if there's anything you need to do on the US side as far as reporting. But as far as your local account, certainly, that's exempt.
Okay. All right. Actually, that was another question I think I had. regarding the when you trade. I noticed that, for instance, ABSA has a higher margin, initial margin percentage, and it's you only required $1,500. Yet Safaricom is only 10%. I don't know how the valuation goes there. Why one has a initial margin higher than the other?
It's so it's a factor of where each of these contracts trades at, the price the company, the share price actually, as well as the riskiness or volatility of that counter. So these figures, 3,800, 4,700, 5,800, are based on an in-house analysis on the volatility of each company. And what we're doing is asking ourselves, what is the worst case expected loss for anyone holding one of these contracts? That then guides us as to setting the margin requirement. So this cash figure you see. So in the case of ABSA, this 1,500 shillings. So essentially our models and everything is telling us that, within a certain level of confidence or reasonableness, we don't then expect ABSA to move against you by more than 1,500 shillings over, I think, a 2-day period, thereabouts. ABSA currently trades at around 8 or 9 shillings, which is why then, if you look at it in percentage terms, then that margin requirement then starts to approach the 20% mark. Safaricom, on the other hand, is currently trading at close to 40 shillings, which is why then if you come back to look at it in percentage terms, that outlay is significantly lower. So it's oftentimes a lot to do controlling for the riskiness and volatility. It's a lot to do also with where that counter is currently trading at.
Very cool. All right, another question from CPG. If a broker is trading on my behalf, are there additional fees, or is that included in the 0.17% cost?
That should be included in the 0.17% cost, unless you agree with the broker, maybe in your agreement, any sort of value-added services. But on purely execution, including trading on your behalf, it should really be the 0.17%, through which the broker has already collected 10 basis points on that trade.
Very cool. All right. I don't see any other questions. If somebody wanted to, all right. So I don't see any other questions, Geoffrey. But if someone wanted to unmute themselves and ask this question, you know, some people don't like posting. They want to hear from you. If you can unmute yourself and ask the question, that's perfectly fine. Other than that, I don't see any other questions here. Oh, Tim, did we answer your question about, I think Tim, you had a question about
I think you answered all of them.
Yeah, okay, okay. All right, awesome. I don't see any other questions. So what I can do, those that missed the monkey, oh yeah, here you go. There's a question about, can we reach you directly? Yes. So those that are in our Discord channel, Geoff is right there. I think his handle is Mobutu. And we'll make a formal introduction to him to our members, just so that you have a question about derivatives. That's the added bonus of joining the community. You have access to all these people that you can directly just reach out, call, get this information. And that's why the online community is great, because we share this information, we gather our troops, we rally behind each other. We don't let anyone just get tackled over. All right, so if there's no other...
Yeah, sorry, I'll just add, I'll share my email address as well. For those that just prefer to send me an email or anything, just in case, just so I don't miss anything. Yeah, so I think, and I've also looked at your Wix presence. So anything between that and emails, that's perfectly fine.
Correct. Awesome. All right. So, Geoff, if you can stop sharing, I'm going to go ahead and provide our website here for those that would like to get in touch with us about this, let me see if I can share this. All right, so this is the analog that we gave about the monkey business. And now there was a lot of jargon that Geoff presented, mark to market. There's a lot of information that I know some people are wondering, what is this? We have actually a futures class that we teach here. And this class is going to reflect exactly all the information that you need to trade in NSE. And you could actually have the best of both worlds, where you can trade futures here in the US and also trade futures in NSE. So having that information before you do anything is important. If you would like to enroll in any of those courses, we do have one coming up on June 3rd. Get yourself equipped before you trade anything. Like Geoff mentioned, you can be closed out or penalized. You don't want to do that. Get yourself information before you do anything. And then obviously, if you are not a member of our community, go ahead and choose a plan, join our community. We have a Discord channel, we have a Wix channel where all this information is actually posted. The presentations, the articles, any question you have, someone in the community is going to answer it and enable you to trade in any market at all. But that's essentially what we do. And I'm glad that Geoff, you're able to do this. If you have any closing thoughts before we finish.
No, just thanks everyone for your time. As I said, we really welcome and encourage you to join the market as well as spread the word. I think particularly on the retail trading front, as I said, that's really been who's supported us in this early stages of the market. And that gets you a lot of the early traction that helps us continue to build liquidity and the profile of the market. So yeah, for this and really lots of other opportunities back home, I encourage you to just jump in, give it a try. Have your own experience. The PowerPoint can only take you so far.
Correct. Thank you so much, Geoff. We're going to let you go. We'll hang around with Timothy just in case you wanted to learn a little bit more about what we do. We'll have Geoff as a resource for us. He's very helpful. There's a whole team at that next platform that we can tap into. We're going to have him actually come over periodically because this information will always keep accruing. You know, if they add new companies, we need to know. If there is a leverage that we can use, it's awesome. So Geoff, I really appreciate your time. I'm so glad that we're able to connect. Thankful that you're able to do this very early in the morning. Now you can at least have some breakfast.
That's the plan. Thank you so much, everyone.
No problem. Thank you.
Thank you, Jeff. Thank you so much. That was great.
Awesome.
It's very eye-opening. It's very empowering, and yeah, I think it's good for us to know, and we can support Jamhuri, and you know, it's given. It's you give, and then you take. So I think it's good. It's really good. Thank you so much.
Come and visit me in Nairobi.
Definitely. Thank you.
All right. Thanks, guys.
All right. So we'll hang around with Timothy just for another couple more minutes. If you have a question for us about the monkeys or this guy that sold all of them, or if you are interested in what we do, any question at all, we'll take it.